Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, U.S. stocks continue their record run. How much more room is there for gains? We'll discuss. Plus, retail sales rose more than expected last month. We'll break down the state of the consumer and how high earners may be masking a broader slowdown. Plus, the U.S. and China reach a framework for a deal on TikTok. Where does the rest of the trade negotiations, where do they stand? We'll discuss that and more on Market Catalysts. Let's get a check of the markets here as we are half an hour into the session. So now we have all three major averages that have turned lower. Futures had been indicating an extension of that record run for the S&P 500 and the NASDAQ. That has lost some steam right now. The Dow is right now down almost 150 points, about a third of 1%. The S&P down very marginally, just a tenth of 1%. Similar situation here for the NASDAQ. So let's take a look at the sectors and kind of where the pressure is being felt this morning. Remember yesterday, the XLC, the Communication Services ETF, actually was at a record. So pulling back from those levels today, financials also feeling some pain here. On the plus side, we get energy and consumer discretionary, which has also been on a record run. It is continuing that run here today. So that's kind of the breakdown of where we're seeing the pain. If you look at the Dow, which is the worst of the three major averages, Nvidia and Microsoft under some pressure here this morning. So that's bringing it down. United Health in the red as well. Salesforce I'm seeing there in the red as well. And then taking a look at the NASDAQ 100 here. Remember yesterday we saw Alphabet close at a record and get to that $3 trillion market cap. If we look at the cap here today, it's still holding above that level, but nonetheless it is declining in today's session instead of advancing. You got a mixed picture writ large for large cap technology. Well, Bank of America's September fund manager survey was the most bullish reading since February, with investors largely expecting growth as trade war concerns recede. I want to bring in Rayanne Mitrione, Callan Family Office market strategist and founding partner. Rayanne, so we've got this positive sentiment. We've got, yes, stocks kind of treading water today, but overall this upwards push. Is there anything that's going to stop it? Are there any big risks out there that could sort of bring a pause or any kind of stop to the momentum?
Thanks, Julie. There are certainly some risks on the horizon, and we've seen softness in the labor market. But right now, I really do think it's a momentum story, as we're seeing, a lot of the AI push stocks up, and now looking at seeing a Fed rate cut coming tomorrow should be another catalyst for another leg up in the markets.
If the rate cut is happening because there's concern about jobs, at what point does this enthusiasm momentum say, well, wait a minute, if jobs are being lost, then is there a risk to growth? I mean, retail sales didn't show it today, but how do you kind of think about that?
If we start to see some real weakness, like right now, the labor market really isn't in a dire situation. So we've certainly seen softening, and the picture's very different from what it looked like a few months ago. But unless we see some real weakness, rate cuts are really going to be more supportive, and it's not going to be viewed as something that's more in relation to a real weakness and real economic concerns. And in fact, it could lead people to be more comfortable and see business confidence come back and consumer confidence improve as well, that the Fed is being more accommodative and willing to really help support the economy.
What would real weakness look like, right? As you said, we've seen softening. What would sort of be more, tip it over into being more alarming?
I mean, we're in a point where we're just seeing fewer jobs added for the most part. If we start seeing real broad layoffs and real declines in jobs being lost, if we see that picture shift into that territory, then I think the concern becomes more broad. And if we see it start to spill over into earnings, I mean, earnings have been really strong. I mean, they've been incredibly strong. We've seen, and not just in large cap, we've seen it in mid cap and small cap as well. Over the last 5 quarters, the second quarter had the strongest beats that we've seen in recent history. So the companies are in a good spot. Corporate balance sheets are strong. The consumer has been incredibly resilient. So right now, overall, things still look pretty good.
And it's interesting, my colleague Allie Canal wrote about that in our morning brief newsletter a little bit, the idea that you've got this job softening, but corporate earnings are strong. And actually, if companies aren't hiring as much, that actually can be a little bit of a tailwind maybe for margins at some of these companies.
Exactly. I mean, and that's what we've seen. We've seen margins actually looking good on earnings reports as companies are kind of being more cautious. So in this environment and not adding unnecessary costs until there's more clarity around what the future picture will look like. So that's actually been a good thing. But we'll just have to see how it plays out going forward.
And sort of what's been your investor playbook, and is there any reason to change it as the Fed starts to cut rates?
We do think there may be more of an opportunity in small cap going forward. It's been underperforming for such a sustained period of time. But earnings have been looking good. I mean, over the last 12 months, earnings growth has been around 11.6%, so not as strong as large cap, but strong. Valuations look good on a relative and an absolute basis, so below long-term averages even for small cap. And this rate cut should be a good catalyst. If we see at least a couple rate cuts, smaller companies tend to have higher levels of debt, more floating rate debt, so they're more impacted in that. So we'll have to wait and see if this is the start of a new long-term trend, but it's hard to argue against kind of right-sizing exposure that's probably underweight just as a function of large cap outperforming for so long now.
At the same time, it's not like you're saying abandon large cap and large cap tech, right? You're still saying investors should be in those names as well.
Absolutely. I mean, the AI theme we're just in early innings there, and we want to have the mega cap tech exposure. We want to have broad market exposure, but we do see more upside for those mega cap tech names as well.
Now, you guys are a family office, so you're catering to high net worth individuals. And there was some interesting data out this morning from Mark Zandi, which just talked about the enormous chunk of consumer spending that is happening in the U.S. that is from the highest, the wealthiest individuals. Have you seen any kind of hit to sentiment from your clients? What are they most concerned about right now?
Yeah, we haven't seen much of a hit, and it is different when you work with ultra high net worth investors who really have multi-generational wealth. They're more focused on the long term, so we're not looking at what, when we get sell-offs like we saw in April, they view it more as a buying opportunity. So can we buy more? Can we do some loss harvesting to offset some gains? So it's more looking at where are there opportunities, how can we capitalize on this AI theme that's going on in the markets, and how are we positioned for the long term?
Okay, Rand, thank you so much for coming in. Appreciate it. Good to see you. Coming up, the CEO of Best Buy joins us for a look into the health of the consumer, tariffs, and more. That's next on Market Catalysts. Retail sales came in above estimates for August, rising 0.6% from the month prior. To dive deeper into the state of the consumer and how they're spending on things like electronics, we've got Yahoo Finance senior reporter Brooke DePalma standing by with Best Buy CEO Corey Berry. Brooke?
Thanks so much, Julie. Corey, thanks so much for joining us this morning.
Of course, thanks for having me.
I do want to kick off with the retail sales number. We did see some softness within electronic sales last month. They were up about 0.3%. Describe to us exactly what you're seeing with the state, the demand of the consumer heading into the holiday, and are they pulling back a bit?
Well, we actually had a chance to release our earnings at the end of August, which is perfect timing. And we had said at that point, we were already running in low single-digit positive comps. We were seeing strength in computing and gaming and headphones and wearables and mobile. So we actually were continuing to see that strength, especially through back to school. And then we forecasted that for the quarter, we'd probably end up similar to our last quarter in terms of comp growth. So it's a consumer who actually, in our mind, has stayed pretty steady in terms of demand.
For months now, we've been discussing the FOMC meeting out tomorrow. Markets are pricing in a quarter-point cut. What are the headwinds up against consumers right now, and how do you expect perhaps a cut to impact the consumer behavior?
I mean, I think what's hard is the consumer is not a monolith, as you know, and we're seeing some different behaviors depending on the consumer. We see almost everyone looking for value. Now, people describe that differently, but very peaky events like back to school or our Black Friday in July event. And at the same time, when there's innovation, something new, like the Switch 2, or like some of the new rev of computing that we're seeing, people are willing to spend on those higher price points for those items that they know they're going to have for multiple years. And so we actually are seeing a consumer, while bifurcated a bit, still willing to spend if they really feel like it's a great value.
And in your last quarter, you did say that third quarter same-store sales are expected to be in line with Q2, but like you just said, we have this Nintendo. We also got those latest announcements from the Apple around the iPhone, the watch, AirPods. Do you think that it just won't be enough to really see a surge in growth here?
I think what we're looking at, back to the consumer point, is a consumer who's being mindful and choiceful. All of those innovations, especially for our model, that is what feeds our model. We consumerize new technology better than anyone. And so we're super excited about those things. And at the same time, very low housing turnover, so a challenge in some of the major appliances or TVs areas. So we're kind of trying to find that balance between super excitement about what's coming and at the same time a consumer who's just being a little bit more choiceful.
Yeah, I do actually want to hit on that because the housing market is something that I've been discussing with executives. I did speak to Lowe's CEO, and what he said was something really interesting. He said that a sub 6% mortgage rate may be a catalyst to get the housing market inflection really started here. You did see declines in appliances and home theater. Yeah. But do you see a turning point to really get consumers back into those big ticket items? Does the housing market need to change here?
I think the housing market definitely helps. It's not the only thing.
Yeah.
Innovation, large screen TVs, those are also things that make people just excited to want to, especially have entertainment at home when maybe they don't want to spend the money to go out. And so there's a real value prop there. However, having more turnover in the housing market definitely helps because you're more likely to outfit that entertainment room or your kitchen or any of those spaces. And I agree with Marvin. I think that if you could just get below kind of this catalyst number, you might start to see that turnover because I think people are really looking for just an affordable new home to buy.
Yeah, and when you think about appliances and home theater, these are pricier goods. Are the everyday consumer going for it? Do you see only high income shoppers really willing to spend that sort of splurge?
I think what's great and unique to our model, all we do is consumer electronics. And all we think about is how can we provide the biggest, widest assortment at all the price points. So we have everything from a very opening price point. You can get a humongous 100-inch TV for sub $1,000. Or you can work your way all the way up to the most premium TV that you could want. And our goal is just whatever your budget is. Doesn't matter where you are on the income strata, wherever your budget is, we have something for you.
We did hear from Moody's this morning that the high income consumer is really driving spending here in the U.S. Do you see that at your stores?
Interestingly, we have actually seen all of our consumer cohorts continue to spend. Now again, they're thoughtful about what they might go for more of an entry point TV versus a really high end one. But we have actually, when we've even seen some growth in the lower income consumer.
Interesting. And what are they going for? Are they going for those promotional deals?
I think there's a few things. Our model is really built on replacement and replenishment. Your technology it dies on you at some point. And you know, we're 4 or 5 years out from the pandemic. There was a huge pull forward in install base. And whoever you are, you might need something new in order to do your job. Your phone might have broke, you need a new computer, those headphones you really need in order to do your job. And so that's when we want to be there. And it might not be you need the most expensive computer, you just need a good opening price point laptop. And we have a huge assortment of those.
Yeah, AI's been driving the market rally. Has it been driving replacements as well?
I think it is it's part and parcel with replace. So our model works when you've got replacement cycles kicking in and some level of innovation. That is our sweet spot. AI. And in this case, AI being just enough. I mean, it can be something as simple as the AI chips take your battery life from 2 hours to 24 hours. That can be a compelling feature for those of us who travel all the time. And so all we're trying to do is make sure we've trained 30,000 associates to help customers understand what really can they do that's different with AI. And a lot of customers just want to future-proof themselves and make sure they have the right capacity for wherever AI takes them.
And these are things we've been hearing throughout all your quarterly results. Another thing that we've been talking about so much over the past 24 hours is President Trump's giving the idea that maybe companies would pull back and only report twice. We did ask Okta CEO just before about this. He said it's great to talk to investors, but there is this industry obsession about quarterly earnings. What's your take on maybe reporting only twice a year?
I mean, I think our focus has always been how can we get investors the most pertinent information at the right times to make the best decisions. Sometimes I think when you're in a really volatile backdrop, you do want to be laying some of that groundwork quarterly. For me, that's less about the forecast and more just about providing color, just like what we're talking about the business. Yeah. That being said, I think we're all trying to find ways to free up capacity and make sure we're spending capacity in the most value-added areas.
Yeah, now one thing that does have investors excited next quarter is that marketplace launch.
Yes.
And so describe to me, how exactly does the Best Buy marketplace marketplace differentiate from what we see at some of your top competitors like Walmart and Amazon, and even maybe Target there as well?
Well, I think we are different. All we do is specialty retail and specialty consumer electronics. And we're approaching this, and the reason we started is we could see customers searching for things we didn't have. You might need that iPhone 12 case. We're on 17 now. I can't carry all of those things in the store. I can't carry every color of blender. This gives us a chance to have this deeper assortment, sharper price points. We can bring on innovative, new, exciting technology vendors that may not otherwise be able to handle our scale. And then we can bring on some ancillary products. And those are the kind where we can see people like curious about, do you carry a pool robot? Well, maybe not in store, but now we have this broader assortment. And so I think we are also trying to do it in a way where you can bring back your product to the store. We'll help facilitate that return. We have universal return windows. We're trying to think about how to do this in a way that really aligns with our brand and yet kind of opens the aperture on what's possible.
And one thing that you're opening the door to is I saw on your website you have these release dates around Pokemon cards and all the collectibles. I mean, what sort of response have you gotten to these trading cards?
It's incredible. And this is where I think us really understanding our customers, not just what's the technology they buy, but what are they interested in? And more importantly, what are they passionate about? And this is a space where people are passionate.
Very passionate about it.
And so we want to bring that energy. We want to bring the energy to the stores. We want to be there for our customers. And trust me, there are lines and people are passionate. And so we want to keep exploring this space because our biggest objective is to bring that fun and sparkle to what it is that we do.
And last question here, as you head into the holiday, what have you seen so far in terms of just the response? What are consumers really looking for right now in terms of products?
Yeah, we've seen growth really broad-based across a lot of different categories, and there's a bunch we're excited about. Handheld gaming is big, and that's Switch too, but it's also a lot of development from other manufacturers who are really entering that space. Computing continues to be strong. You have Windows 10 sunsetting, moving up into Windows 11, so there'll be a big driver there. We continue to see strength in our mobile business, where people are looking for at least the replacement of that phone, and some new form features there. Strength in headphones, strength in wearables. Like, there are a lot of different facets where we're seeing demand, and we are super excited to bring those to life for holiday.
Corey, I may have to splurge on those new AirPods. I saw them.
They're lovely. They'll track your heart rate.
Best Buy CEO Corey Berry, thank you so much for joining us.
Of course, thank you.
Back to you guys in the studio, Julie.
Cool gadget talk, love it. Thanks, guys. Coming up, we stick with the state of retail as Ralph Lauren unveils its 3-year financial plan. We'll tell you what the stock is doing after the break. Now time for some of today's trending tickers. We are watching Ralph Lauren, Dave & Buster's, and Alphabet. First up, Ralph Lauren, the company unveiling its long-term financial outlook at its investor day, but investors don't seem that pleased. The fashion house sees revenue growth remaining similar to recent rates over the next 3 years. It's projecting sales to grow at a mid-single-digit percentage annually through fiscal 2028. That is roughly in line with estimates from analysts, but it's slower growth than the company has posted in recent quarters. That said, Ralph Lauren does plan to return at least $2 billion to shareholders through fiscal 2028. The shares down about 2.3%. Next up, Dave & Buster's. Those shares are sinking after the restaurant operator reported disappointing earnings results. Adjusted earnings per share and revenue for the second quarter came in well below the average analyst estimate. Shares are now poised for their biggest drop of the year. They're down 17%. But Jefferies analyst Andy Barish did highlight the company's new CEO has a back-to-basics strategy that has shown some early signs of stabilizing the business. And finally, Alphabet, parent company of Google, unveiling a $6.8 billion investment in the United Kingdom focused on AI. The tech giant disclosed the plan just as President Trump is set to announce billions of dollars of economic deals during his visit to the United Kingdom. Part of the investment will go toward advanced computing hardware for a $1 billion data center. That center will help meet growing demand for Google's services, including search and maps. That's all according to its statement. The shares right now are down 1/3 of 1%. Remember, yesterday they were at a record as Alphabet breached the $3 trillion market cap level. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page.
I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. First up, Warner Brothers Discovery. TD Cowen is taking a step back on the media giant, downgrading the stock to hold from buy. The firm kept its $14 price target, but says the recent rally, fueled by speculation that Paramount Skydance may be eyeing a bid, has taken shares well above their fair value. TD Cowen notes that while a takeover bid north of $20 a share is possible, it's far from guaranteed. Without it, the firm said the stock could quickly slide back into the $11 to $12 range. Bottom line here, investors are betting on a buyout, but analysts don't like the odds if no deal comes through. And just a few days ago, Democratic Senator Elizabeth Warren of Massachusetts said any deal between the two companies must be blocked. Next, a sweet call from Goldman Sachs. The firm double upgraded Hershey to buy from sell and hiked its price target to $222 from the prior $170. Goldman points to improving market share trends and says Hershey's strong pricing power on its iconic brands should drive growth into 2026. While cocoa costs and tariff pressures remain headwinds, those risks are now priced in. Goldman's price target implies about 20% upside from where the stock closed Monday, and the firm sees a setup as a, quote, compelling risk reward after a tough year of guidance cuts. And finally, turning to Apple. The stock has lagged as Mag 7 peers on AI hype, but Bernstein is calling the company a winner in what it dubs the intelligence revolution. The firm initiated coverage on IT hardware more broadly, naming Apple, Dell, Seagate, and SanDisk as top plays, all with outperform ratings. Bernstein argues that AI is reshaping demand for devices, storage, and servers, creating a massive and sustainable growth opportunity. Importantly for Apple, early data from JP Morgan suggests the iPhone 17 upgrade cycle is off to a strong start, giving the company some much-needed momentum that could help close that performance gap with peers. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Treasury Secretary Scott Bessent, fresh off of trade talks with his Chinese counterpart in Madrid, saying he believes the U.S. and China can reach a deal before the pause on steep tariffs expires in November, anticipating another round of talks before then. Speaking to CNBC, Bessent saying, quote, each one of those talks has become more and more productive. I think the Chinese now sense that a trade deal is possible. For more on what to watch as negotiations continue, Shehzad Qazi, China Beige Book International Managing Director, is joining me now. Good to see you.
Good to see you.
Do you share the Treasury Secretary's optimism?
Well, look, a deal is possible, but I think we need to be careful about what that really means. I don't think we're going to see any kind of big blockbuster U.S. China Phase 2 agreement. At best, I think what the Treasury Secretary is talking about, they're inching towards some kind of Phase 1 redux, where China perhaps makes a commitment to buy a certain amount of U.S. goods and such in exchange for us bringing the tariffs down further and so forth.
So does that mean that there is a meaningful change from what was achieved in the first Trump presidency, for example? Like, kind of set the table for us. What's different now? What could be achieved out of this that wasn't achieved then?
As a matter of fact, nothing at all. The first agreement would probably look more ambitious at this point because it at least had claimed on paper that they were seeking to achieve structural changes from within China that was going to alter somehow that trading relationship they have where China just gets to dump its products abroad and the U.S. runs a major deficit. That's not happening this time around, I think, at all. And if you think about the bigger picture goal of altering America's trading relations with the world's second largest economy, well, that is now looking like a goal that's receding in the back.
And if you look at the backdrop, which is what you do, you try to look at the real economic indicators behind the official economic data coming out of China. Looking through that prism, how motivated is China at this point?
Well, look, there is no pressure on them still to come to the table with any kind of big deal or any kind of big gives. As a matter of fact, if you look at China Beige Book's August data, what we saw was that the economy is actually starting to turn a little bit of a corner, it seems like. Things are finally getting better compared to year-ago levels. The consumer spending results actually looked fine. Manufacturing looks like its orders picture is pretty strong. So whereas I think China China, may have exaggerated how strong they were earlier in the year and is seemingly putting out somewhat softer data now. We're seeing the reverse. They got hit initially when the tariffs went into place and are actually seem to be climbing out of that as the summer comes to an end.
Why is that happening? Because you would think, with the tariffs that, some manufacturers are pulling back on orders still or moving capacity when they can to other countries.
Yeah, we don't, I think, have the kind of big exodus of Chinese manufacturing out or manufacturing out of China, I should say. Instead, what you're getting is China's trade with Southeast Asian countries has been exploding. Its trade now we know with Africa is exploding. And so what is probably going on is that where direct U.S.-China trade might be slowing down, you're getting most likely a pretty serious rerouting of goods happening, transshipment, which is the other big concern, of course, that the U.S. Trade Representative's office and the administration have had.
Yeah, and they have said that they're going to try to prevent that in various ways, that rerouting, if you will. But it sounds like that effort is not really changing much at this point.
Oh, I don't think much has been done at all. I know that there's some task force that has been announced, the Department of Justice. We'll see what they accomplish. But the reality is this is an incredibly cumbersome project, and that kind of, I think, capacity, quite frankly, doesn't even exist here in the United States, let alone existing in places like Vietnam and Cambodia.
Right. So when you talk about that the economic data is now actually looking a little bit better, would you call it an inflection point? Would you go so far as to say that we are really going to see more of an expansion there? Trade deal or no trade deal, by the way?
I think so, because a lot of the pressures seem to be, at least for now, receding. And so it is quite likely that the third quarter, rather than being this boring story that we were getting out of China, at least in our results, which was the economy continues to swim in place, it may actually look like it's turning a bit of a corner, as I said. That's still TBD. We're still running our results, or we're still gathering our results, I should say.
Well, looking forward to that. I talked to an investor in China yesterday, and he sort of said some similar things to your comments. The one thing he still is talking about is the property market, which hasn't really recovered there. But he seemed less convinced it needs to. It's still important, he said. It still would help if it recovered. But it's not sort of that vital piece. Clearly, if the numbers are improving without it. What's your thinking around that?
I actually agree with that. And, whereas Beijing would like to see the housing market recover to a certain extent, they no longer need it to be, or even want it to be, more importantly, that old, 25 to 30% of GDP, which was incredibly unsustainable and dangerous for the economy. So the housing market, it looked like the pain was easing for the last year and a half or so. It's sort of going sideways right now. We'll see where the housing market lands at the end of this year. But the truth is that it is no longer that kind of linchpin of economic growth, and Beijing has been fairly successful in accomplishing that.
Interesting. To go back to trade for a moment, I want to ask about the companies that have sort of been caught in all of this. Thinking of NVIDIA, which the Chinese government has been investigating. I'm thinking of TikTok, which Besson says we're now close to some sort of a deal to allow it to continue operating in the U.S. How should we be? Do you think that there will be progress on those individual situations, and how important are they to the overall talks, do you think?
I mean, they're incredibly important, but what we've seen in the last few months is that there has been sort of this rollback of export controls, which has been incredibly bullish for companies like NVIDIA and others in that space. Obviously, we've got a TikTok deal of some sort that's going to be announced, which is not going to be a full divestiture and so forth, which means that chances are very high of it going through now with China. Putting aside all the problems it's going to run into domestically. So look, NVIDIA is kind of winning the day in Washington, D.C. right now. And so that has been quite good for them. It raises, of course, very serious concerns long run for the U.S.-China tech competition.
Well, and long term as well, there used to be China hawks in Washington who were concerned about, had what seemed like some credible concerns about national security, whether it was TikTok, whether it was technology being shipped into China. Are those people, where are those people?
I think the China hawks are still around. Some of them are keeping a low profile. And others, especially those on the opposite side of the aisle, so the Democrats, for the time being, have decided to not be as loud and rather criticize the tariffs, right? And criticize the president's other policies rather than making China the center point of what they're doing. So China hawks are not to be seen as often in D.C. as they were perhaps even 10 months ago.
No, it's really been interesting. Thanks a lot. Good to see you, Shehzad. Well, coming up, retail sales show signs of strength. More on that and on the consumer more broadly ahead. Rising consumer prices are not slowing down spending just yet. Retail sales rising more than expected in August, with categories like e-commerce, clothing, and restaurants leading growth. So how long can the consumer remain resilient? Joining me now, Deborah Weinswig, Coresight Research founder and CEO. Deborah, it's good to see you. So I know there was some talk that back to school was sort of driving some of these trends. How are you reading the numbers?
Well, first, Julie, thanks for having me on. And secondly, as you start to look at the numbers, right, we're coming off of July where we had Prime Day and many retailers who piled on. So some of the concern had been that some of that had been pulled forward. But I would say if we look at the strength in August, and if you remove inflation, right, we saw real growth. So there's something underlying that seems to be really driving sales in the economy. And that, I think, is definitely signs of improving confidence.
And that's interesting. And how did that play out across what people were buying?
Well, as we look, food sales continue to be strong, grocery across the board. Secondly, as you mentioned, e-commerce was strong, but outside of the department store sector, which continues to, I think, try to regain its footing, we saw pretty broad strength. Building materials and whatnot also weak, but as to be expected. And so I think that the sectors that you would expect to be weak were, and those that were strong were even stronger than expected. And that, I think, is an interesting theme going into the holiday season.
What's happening around apparel is kind of interesting here. You were looking at some of the company commentary as well, not just these macro figures, but what companies were saying about demand. What kind of stood out to you?
Well, we've seen broad-based demand. And if you look across kind of specialty department stores, athletic footwear, apparel, and leisure, the kind of athletic apparel market has, I'd say, been a bit more volatile, but some of that has been kind of fashion hits and misses. Specialty apparel, once again, has been stronger than expected. And if we think about kind of where we are in the back to school season, that does make sense. But I think it also goes back to these retailers that have done a much better job on inventory and taking calculated risks in the kind of macro, let's say, supply chain tariff environment that we're in. In some cases, having pressure to rethink your lines of business does lead to positive outcomes, and I think we're seeing that.
Interesting. I want to flag some research for you that came out from Moody's Analytics and Mark Zandi over there, where he was analyzing the Fed's consumer spending data by income distribution. And basically this chart shows that the top 10% of earners or of income accounted for almost half of all spending. This was for the second quarter. And he tracks this data going back to, or I guess the Fed tracked the data going back to 1989, and this is the highest it's ever been. So if that is, obviously it's very uneven in terms of that top distribution. So how should we be thinking about then, there's a lot of talk about the K-shaped economy and that the lower incomes is not spending as much. From a broad economic perspective, how much does it matter and how should we be thinking about that?
Yeah, we've actually, starting in 2020, we started to do weekly surveys. So we have, I would say, higher frequency data than, kind of Mark Zandi. And so what we're seeing is just a lot of volatility week to week, and that's across income groups. But to your point, the lowest, and we look at 50,000 and under, 50 to 100, and 100,000 and over, that under 50,000 is where we're seeing the greatest volatility and the greatest weakness. And I would say going into back to school, we're seeing even additional weakness. And those kind of top two income bands are continue to see volatility, but volatility to the upside. So I would say that, to your point exactly, the higher income groups are seeing volatility, but it's in a positive direction. And as a result, we are seeing strength in, look at what happened in second quarter earnings, right? You look at the TJ Maxx's, the Ross stores, the Burlingtons of the world, compared to some of the other specialty retailers. You also look at the dollar stores. And so I think that it's across income groups. We're seeing consumers are being much more thoughtful in their purchases. And what continues to be interesting is that they're visiting more locations per shopping outing, if you will, right? So they're really looking for deals, and that is across income groups. Outside of like ultra high net worth individuals, where they're looking for convenience, and that's a whole different demo. But I would agree with you 100%. We are seeing real change based on kind of income groups, and that is, continuing to bifurcate at a measured pace.
That's really interesting. So I guess what can we extrapolate from all of this about what's next, right? Especially when you also account for things like the recent jobs data, for example.
Yeah, so I think as we go into, right, I mean, these days, holiday kind of starts October 1st. And so I think everybody has an eye towards that. And many of the studies that have come out have talked about kind of, Gen Z, and, they're talking about spending less over the holiday season. But I think there's this idea of gifting for others and gifting to oneself. And so when you take that all into account, it looks like we're probably up 3 to 4% for the holiday season. We do have potentially some mismatches between demand and supply, right? With retailers being very cautious on inventory ordering. So if we go back in time and think about 2020 and 2021, those were two really strong years for retailers because you didn't have enough inventory to really match demand. And so we saw less discounting. I think we'll see a version of that this holiday season. And I think the retailers have been very cautious, and consumers have been somewhat, let's just say, more intentional with their spending. So I think we'll have a solid back to school. I think as we look into 2026, that's where the crystal ball gets a bit murkier. But I think that, based on the data today and what we know for the rest of the year, I think we'll have a solid back to school season. I think when it comes to 2026, there are concerns that bifurcation between, let's say, 50,000 and under and 50,000 and above, that continues to widen. And the impact of that may be more significant in 2026.
Interesting. Deborah, great to get your perspective always. Thank you.
Thank you. Take care.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, President Trump proposes changes to the Wall Street sizes of companies, how they report. Plus, buy high and sell slow. We'll speak to one investor highlighting flaws within index funds. And we hone in on the energy space and look at the boom in clean power demand amid the rise of AI. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets, taking a look at the major averages here and what we are seeing. We got a little bit of a pullback here today. The Dow down by about 170 points. That's about 1/3%. The S&P and the Nasdaq falling slightly from their record closes yesterday. Well, President Trump is proposing changes to the way the publicly traded companies report earnings, saying a switch from quarterly reporting to just twice a year would be beneficial for companies. We got a chance to speak to a few executives this morning and got their take on Trump's suggestion.
It's not a bad way to kind of incentivize long-term thinking rather than just a quarterly outlook.
I'd be okay either way. I do like the opportunity to talk to investors every quarter about the business and the future and the vision of what we're trying to do. But I do think sometimes the industry gets too obsessed with the quarterly numbers and infers too much forward guidance and forward momentum or lack thereof from a single quarter.
Sometimes I think when you're in a really volatile backdrop, you do want to be laying some of that groundwork quarterly. For me, that's less about the forecast and more just about providing color, just like what we're talking about the business. Yeah. That being said, I think we're all trying to find ways to free up capacity and make sure we're spending capacity in the most value-added areas.
Joining me now with their thoughts on the matter, Bill George, Harvard Executive Education Fellow and former CEO of Medtronic, and Bryce Tingle, University of Calgary Professor of Business Law. Thank you both for being here. I have to say, Bryce, what a coincidence. You wrote a piece for the New York Times, an op-ed that was published yesterday that just more broadly looked at changes that you think need to happen in terms of regulation of U.S. corporations. Then here comes President Trump proposing this. Do you think this specifically, the changing of the timing of reporting of earnings, would be a helpful change as well?
Well, I like to think I inspired President Trump. But, I think it's a good idea, to be honest. London has survived for centuries as an important financial center, and they use semi-annual reporting. I don't think we should be making rules about this sort of thing. I think shareholders and managers of businesses are perfectly capable of determining what the right reporting schedule is. I think there's a lot of companies that would benefit from lower costs associated with financial reporting, and would benefit maybe from a longer term focus, that not having to sort of address quarterly performance every 3 months would permit. So I think it's a good idea.
Bill, you've been in that CEO seat. You've had to, be on this cadence, this hamster wheel, maybe, of quarterly reporting. Is it a blessing or is it a curse or somewhere in between?
No, I very much favor going to semi-annual reporting. I think you'll find most all CEOs do. To some of the comments made earlier, there's no reason they can't meet with their investors and talk to them every quarter, tell them generally how things are going, as long as they tell all the investors and not just inside information. But I do think that this would be very salutary in getting people to focus more in the long term. Right now, all the CEOs have to play the expectations game because the market demands it. If we can stretch it out to twice a year, I think it will get much more focused on strategy, give us more opportunities to invest longer term in research and development, new capital facilities, expenditures. So I'm very much favor the longer term. And I hope that we move in this direction. I think President Trump gets it right. So does Bryce.
Bryce, I want to zero in on something that Bill said. He said, as long as they tell all investors. And I have seen some critics of this proposal raise the concern that this would give large institutional investors and or hedge funds even more of an edge because they have sort of their proprietary ways of ferreting out data. Do you share that concern?
I don't. And again, because this has been done. It's been done for centuries. We know what semi-annual reporting looks like. London's not the only jurisdiction to have it. And we have deep, effective, accurately priced markets, and markets that attract investors because they seem fundamentally fair. I don't think that quarterly financial results materially change the picture of companies in the ways that some of the people who make this argument suggest. I think companies' performance is relatively predictable over such short periods of time. I also think that, in an era where there's index funds that just invest, regardless, apply no thought to the pricing of securities, having active information gathering investors helps produce efficient market prices, which, let's face it, is really what investors rely on. They rely on the market price to bear some resemblance to the underlying value of the business and its future cash flows. They're not themselves poring over quarterly financial results.
Right. And Bill, on the other hand, when we talk about some of the other changes or policies that this administration has put in place, things like tariffs, for example, is this sort of classic Trumpian look over here, don't look over here, or have companies adjusted to the tariffs and it's sort of they don't have anything to do with each other?
No, I don't think they have adjusted the tariffs, and we're going to see increasing inflation as a result of it. I think that's inevitable. And no, I think the president's serious about this. And by the way, one change it would bring about, Bryce, you've written on this, is I think it would get boards of directors more focused on strategy and building the business and long-term growth. Right now, their boards spend a lot of time worrying about quarterly earnings. Frankly, they have zero influence on the quarterly earnings. They can have a lot of influence on the longer term, and that's where they should be spending their time, looking at the culture of the company, how well it's true to its mission and values, and not focusing on the short term. Let management do that, and they produce the results every month, but it doesn't have to be public, so that becomes a focus of investors.
Bryce, to Bill's point, let's get to some of the other things that you talked about in your piece in terms of other sort of structural changes that could be made. And one of them does have to do with boards, which under regulations, you have to have independent board directors. Why is that not a good? I mean, it sounds good on paper, right? To have people who are not sort of buddy-buddy with the executives at the company.
Yeah, and independent directors are good. And there's some great independent directors out there. I'm an independent director, and I like to think I'm okay. The problem, though, is that we took a good idea and we turned it into almost the only idea we have about board composition. We now have boards where, in most boards, the only inside director is the CEO. And so you have a board that's entirely filled with individuals who only know what's going on in the company because they're told by the CEO, and whose only stake in the company is stock options and maybe a bit of reputation. But they don't have deep ties to the company the way inside directors do. And when you look at this point, 40 years of empirical research on boards with sort of all independent directors, you find in the research either they don't outperform boards with inside directors, or in many cases, they do worse.
Bryce, if I can just jump in here, Julie, and add to that. I like independent directors. I've been one, but I think they actually have to understand the business. And the governance gurus 10, 15, 20 years ago decided, if you were a customer of a company or a supplier, you couldn't be on the board. He can be the most valuable people. And we got to going to diversity. We went almost too far in looking at that as a primary criteria. I think we really look to have a board that's knowledgeable, former CEOs and people that know something about the business. And we've made it too hard for them to become independent directors. So I'd like to encourage that because I think that can be extremely helpful.
Bryce,
and if I can just add to what Bill says, this idea that independent directors should be the only directors on the board besides maybe the CEO is based on the idea that the only value that a board contributes is keeping an eye on the CEO, monitoring management. But anyone who's been in a boardroom realizes the real value directors give is in strategy and making connections and providing a sober second look and acting as a sounding board. Boards should be selected for those qualities, not just the empty category of doesn't know the CEO very well, may not like them.
Bryce, just to play devil's advocate for a moment, I mean, you could look at the U.S. Corporate in aggregate, corporations in aggregate. You could look at their performance. You could look at GDP growth. You could look at performance of the stock market. You could look at sort of business creation as well in the U.S. All of these things, on a relative basis, you could say are better than most other places in the world, right? So
they are.
What kind of upside could this unlock, or is this are we already sort of best in class in the U.S.?
Well, first of all, the United States, particularly its ecosystem for creating innovative companies, is, I think, rightly the envy of the world. So you're exactly right. So there are things we're doing that are really good. Most of that happens a bit downstream, though, of the public markets. What we've seen over the last 30 years is out of, let's say, 1,000, and this was a study performed a couple of years ago, out of 1,000 successful exits of venture capital companies, these are companies financed by venture capital firms that are successful, less than 100 went public. That's what's changed. We've gone from a point in time when most companies went public to a point in time when virtually none of them do. And fixing that, I think, is really important for the United States.
Well, and
Yeah,
Bill, I mean, you've consulted to all kinds of companies, Bill. Do you think that this is these kinds of regulations are a real obstacle, and one of the reasons why we're not seeing some companies come public, or why we're seeing them balloon in valuation and still not coming public?
No doubt about that. I remember talking to Michael Dell at length about it years ago because he couldn't get enough opportunity to focus on rebuilding his company for the long term. And I think that's why companies are staying private right now, or going private. And I think it's a real concern because being in the public market is so much pressure on the short term that you can't build a company for the long term. The reason the U.S. is so innovative, the innovation is coming from small companies that are private. They're being funded by venture capital. And Americans in general are much more willing to take risks. In a lot of European countries, one failure in taking a risk is considered the end of your career, whereas in the United States, it's considered a learning experience. And I think this innovation we have here is absolutely critical. So let's not confuse cause and effect. I think the dynamism of the U.S. market comes from innovation and investments in innovation, and a lot of that's happening on the private side.
Bryce, one more quick one to you related to all of this. We are seeing almost an opening of the private markets. In other words, more access on the part of investors to invest in various ways. What are the risks of that? You know, if these companies aren't going public, obviously they're less transparent in the private market. So do you run the risk of some individual investors running into trouble there?
Of course you do. And so we've had a strong prejudice for almost the entire history of securities regulation in the United States. Since the 1933 Act, we've had a bias against private companies letting individuals invest in them. But as the public markets shrink, and as they increasingly embrace a narrower and narrower slice of business, and as more and more economic activity occurs in the private markets, there is going to be, a really irresistible force drawing investors into the private markets.
Bill, Bryce, really interesting discussion. I hope to do it again sometime. Thank you.
Great question,
Thank you.
Julie. Thank you.
Yes.
Coming up, the flaw in index construction that investors might not know about and how it could affect stock performance. Markets pulling back from recent records with the Dow leading losses, the S&P 500 and NASDAQ close to the flat line. If the NASDAQ 100 closes higher today, it would be the 10th consecutive day of gains, its longest streak since November 2021. To talk more about the markets and the outlook, I want to bring in Rob Arnott, Research Affiliates founder and chairman. It is always a pleasure to get to catch up with you. It's been interesting lately, this sort of melt up that some have called it in the markets ahead of the Fed. What do you make of the backdrop right now?
Well, firstly, I think the economy's been more resilient than a lot of people expected. The tariffs were perceived to be catastrophic doom and gloom for the world economy. And really all it is if you've got a 20% tariff, as a hypothetical example, and it applies to 10% of your GDP, because that's the size of the import share of GDP, then that's 2%. And if it applies to only half of the goods, that's 1%. So it's a little bit like a one-off 1% tax hike. And viewed in that context, people wouldn't look at a 1% tax hike as catastrophic. But the other side of the coin that's interesting is most people would not like a 1% tax hike, and tariffs are a tax. So there's a certain hypocrisy in rooting for lower income and corporate and cap gains taxes and rooting for higher importation taxes. So I think there's some shabby thinking on both sides of the political divide.
So, as an investor, you have to sort of try and cut through that. And as you say, the actual data has been better largely than anticipated. Jobs probably being the notable outlier to that. What does all of this, though, imply for corporate earnings? Because they, too, have consistently been coming in ahead of estimates.
One thing that is shockingly widely misunderstood is the linkage between deficit spending and corporate profits. It's almost dollar for dollar. You engage in deficit spending, profits will almost always go up. And so the fact that we're engaged in prodigious deficit spending is weirdly good for earnings.
Talking about that transmission from one to the other, especially because, not every company relies directly on government spending per se.
Well, think of it, one simple way to think of it is that company earnings are, in a sense, company savings. It's money that they didn't have to spend. And deficit spending is government dissavings. So the one cancels the other.
In the economy overall.
In the economy overall.
Interesting. Okay, so what does all of this mean for where stocks are going?
Well, stocks will fluctuate. On a long-term basis, and I am a long-term investor, U.S. stocks are expensive. That gives me high confidence that you can do better elsewhere. on a 10-year horizon, probably on a 5-year horizon. U.S. growth stocks in particular are frothy and expensive. We have an interactive website, Asset Allocation Interactive, that forecasts forward returns on 130 different asset classes. And it uses simple yield plus historical growth in income plus some element of mean reversion back to historic norms. And that points to a total return for U.S. growth stocks over the next 10 years of 1.5%. That's all.
That's not very much. So
Right.
you said you could do better elsewhere. Where's the elsewhere?
U.S. value is up around 5.5%. Not brilliant, but not bad. International, about 7. Emerging markets, about 8. International value, about 9. Emerging markets value, about 10. If you can get 10% per annum over the next 10 years versus 1.5% per annum, go for the 10.
Yeah, the math works, as they say. I want to talk to you about something else that is a new product that you guys have come out with, because I think it's quite interesting. And basically, you look at the way that indices, market cap weighted indices, are constructed, the S&P 500 being a prime example. And you say, there's something that is a flaw in the way they're constructed. So tell people, explain what the flaw is.
It's really interesting. People talk about index funds as passive, and their turnover is very low, 4 or 5%. So you could more accurately think of it as 95% passive and 5% active. Now, what does that active sleeve look like? That's where all the action is happening. Here you got 95% of the portfolio doesn't change year to year, and that part of the portfolio is blissfully indifferent to whether the companies are going up, down, or sideways, whether they're floundering or flourishing. All of that just along for the ride. But the 5% turnover is wild. You're adding stocks because they have soared and their market cap is now interesting. You're adding them at valuation multiples that on average are twice that of the market. And those are replacing companies that on average, that have cratered, have performed terribly. That's why they're being dropped, and are priced at half the market multiple. So you're buying high and selling low with a 4-to-1 valuation ratio. It's crazy. It's like an emerging growth manager on methamphetamines. It's
But because the bulk of the market cap in the S&P 500, the NASDAQ, what have you, is a handful of large companies, right?
Correct.
At the margin, how much are you leaving on the table
shocking
for
amount.
These companies?
Shocking amount.
Yeah.
Stocks, when they're added, on average, will have outperformed the market by about 75% in the year before they're added. Now, that's wonderful performance, but hey, the index missed it. And then, if it goes on to be a next Tesla or NVIDIA, fine, it goes on to outperform despite frothy pricing. But if it doesn't live up to lofty expectations, it becomes a flip-flop. It's dropped a few years later. So what we find is that over the last 35 years, the S&P 500 and the Russell 1000, 1,500 names, there have been 2,100 additions. That's over 100% turnover. That's wild, but it's actually healthy. It's recognition of a robust capitalist economy. Now, of the 2,100, are there 2,100 deletions? Yes, but most of them are corporate actions. Mergers, acquisitions, and bankruptcies. If a stock ceases to exist, it's out of the index, but it doesn't matter. You don't have to sell it, it's gone. The discretionary deletions have been 960 over that same 35-year span. And of those 960, 540, over half of them were flip-flops. They were added a decade or less earlier. Over a third were added 5 years or less earlier. So added and then, oopsie, get rid of it.
So we don't have much time left, but so how do you correct for that?
You add stocks when the company is big enough to matter. If you had an index of the 500 largest businesses, all of the Mag 7 are there. They're big businesses. But take the 500 largest businesses measured by sales, profits, book value, dividends, fundamental measures. Not by market cap, not by price. And you do not choose to add a stock because it soared. You do not choose to drop a stock because it's tanked.
Interesting.
You add a stock because it's gotten big enough to matter. You drop a stock because the underlying company has gotten small enough to not matter.
So you guys now have this index.
It's Research Affiliates Cap-Weighted Index, RACWI. And RACWI US, there's now an ETF offered by ETF Architect, was launched just last Friday, RAUS. So it's RACWI US, RAUS. When you think about, if you go back over the last 35 years, it would have beat the S&P by 69 basis points per annum. And it's passive, and it's cap weighted.
Interesting.
So if you're investing in Spider or VU, why on earth would you not give Rouse a try, given that it just makes the dramatic change of saying we're not going to buy high and sell low?
Interesting. Thought-provoking as always, Rob. Thanks for coming in.
Thank you. Thanks for the invitation.
Appreciate it. Coming up, much more markets action. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you will see stocks pull back across the board here from those record highs that we saw. The NASDAQ secured its 6th consecutive all-time high on Monday. The S&P also had a record close. But we are seeing some pullback there. NASDAQ essentially trading flat to the downside. S&P is down about 0.1%, and the Dow is off just around 160 points. And this comes as the Fed kicks off its 2-day policy meeting. We have a full house there with Stephen Myron just confirmed in the Senate. Lisa Cook will also be present as President Trump continues to pursue firing her. And given the fact that we do have that 25 basis points worth of cuts being priced in by markets here, we will be closely watching the bond market. Bond yields have not been doing too much. We have the 10-year yield just hovering at around 4%. The 30-year yield is firmly under 4.7%. All eyes will be on the dot plot. What are the expectations for interest rates, not just on Wednesday, but really the rest of 2025 and into 2026? If you take a look at some trending tickers, you're going to see Oracle at the top of that list here. Oracle rising around 1%. And this comes after CBS News reported that the company was among a consortium of firms included in that U.S. China TikTok deal. President Trump and Chinese President Xi Jinping, they will be meeting on Friday to finalize the deal and also talk broader trade implications. And then if I flip over to the NASDAQ 100, you will see a mixed bag among some of the Mag 7 players. Alphabet is down just around 0.3%. And this comes after the stock did secure some gains on Monday, becoming the fourth company to surpass a $3 trillion market cap. You also have Tesla extending the gains that we saw yesterday, up just around 2% after wiping out its year-to-date losses on Monday, following CEO Elon Musk purchase the revelation that he purchased shares in the EV maker for the first time since 2020. Other names that are seeing some gains and today include Apple, Bernstein initiating coverage on Apple with an outperform rating. You have Meta up around 0.5%, whereas Nvidia pulling back a bit, down just around 1%, and Microsoft down roughly 0.6%. But keep it right here on Yahoo Finance. We'll be tracking all of the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Eli Lilly, Nvidia, and Tesla. First up, Eli Lilly, the pharma giant, announcing a $5 billion investment in Virginia as it expands its domestic manufacturing. Joining us for more, our own Brooke DePalma. So Eli Lilly making this announcement. So many companies that have been making these kinds of announcements, right?
Did you even know that there's a list on the WhiteHouse.gov with all the investments?
I did not know that, but
well,
I see that
we
you
have it pulled up. Yeah. And you can see that this joins others like the like of Merck, AstraZeneca, Novo Nordis, also making these major investments. And really this just goes to show that companies are jumping in, saying that they're willing to splurge or willing to spend and invest in manufacturing here in the U.S., especially because of these tariffs.
Right. Although many of them were already making these kinds of plans and announcements. What's also interesting about this one from Eli Lilly is it doesn't seem like this will be a GLP-1 or obesity drug manufacturing facility. This will be at least ingredients that are more targeted, it looks like, autoimmune diseases, lung cancer, so other types of diseases.
Yeah, and I think also too, if you take a look at today's retail sales print, we did see health and personal care stores spending there increase about 6.6%. It really jumped out year over year, that is, because it was one of the largest jumps. And I think this just goes to show that drug pricing and how much we essentially pay for these goods really has been a top focus, not only for these companies, but the administration. And so now Eli Lilly looking to get into this conversation with this investment.
Well, not only that, the jobs report also, I mean, healthcare has been one of the more consistent growing parts of the job market, even while other parts are pulling back. So that's something to keep an eye on as well. Let's also talk about NVIDIA, because Reuters is reporting the company is seeing tepid demand in China for its products, for its new chip in particular. This, of course, coming amid reporting the government told companies to avoid using its products, and as China says that NVIDIA violated monopoly laws. Treasury Secretary Besson also saying he expressed his displeasure over that finding by China.
Yeah, and right now the stock isn't really responding too heavily. It's down about 1% in this pre-market trading. Of course, NVIDIA has seen such growth year to date, up more than 30%. But also this just reminds me of the interview that you did not too long ago with the CEO, Jensen Huang. He said specifically that they have an opportunity to succeed in the China market if they would allow for American tech companies to be able to play there. And so I really think this is sort of a bigger conversation about how exactly these American-led tech companies, AI companies play in this market and the way in which they do it that still boosts demand there, which essentially has really pulled back.
Yeah, and you know, this lack of reaction today to this is not necessarily surprising, because we already knew that the Chinese government had sort of constrained the demand for this chip there. So we'll see how.
They didn't include it in their forward-looking guidance. That was sort of expected here.
Exactly. And finally, let's talk about Tesla. U.S. auto safety regulators have opened an investigation into whether some Tesla vehicle doors are defective, citing incidents in which exterior handles stopped working and trapped people inside the cars during accidents, which is terrifying.
Highly
obviously.
concerning.
Yeah.
Yet the stock not reacting to this news.
Yeah.
Well, that stock up about 2%, and that's really because of this ongoing momentum that we saw on Monday's trading session after Elon Musk purchased 2.6 million shares of the company, the most since 2020, worth about $1 billion. And also, this just goes to show that the momentum behind Tesla, especially with now Elon Musk really jumping back in, showing his loyalty, his position within the company, his focus on the company, has investors excited that they're willing to just sort of put aside this other noise around the company.
I guess, I mean, this is, I don't know if it's noise or not, but specifically, by the way, this is the 2021 model year Model Y, where this investigation is happening. So we'll see how that plays out.
They said that a child may not be able to access or operate the releases, even if the vehicle's driver is aware of them. So essentially, once a person walks out, they may have a hard time getting access back in. I mean, there's just so many concerns around this report. They also said that within this report from Bloomberg, they said that in China, a top regulator is reportedly considering a ban on those fully concealed door handles. And can I just say, Julie, sometimes I even have trouble opening up those concealed door handles.
Yeah.
And so it'd be interesting to see where this ends up rolling out to be.
Sometimes a car doesn't have to look cool; it just has to work.
Just has to drive us to the place.
Let us out when we want to get out of it.
Right.
All right, thanks, Brooke. Well, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Elon Musk bought $1 billion of Tesla shares, his largest purchase in 5 years. Yahoo Finance spoke with a technical analyst about where the stock could go next.
Join me now for a look at the key levels to watch with Tesla is Fairlead Strategies senior technical strategist Will Tamplin. Will, it is good to see you. So Tesla in the green. We've wiped out the year-to-date losses. We turn to you, Will, for that technical take. You look at the charts. What do you see ahead for Tesla, Will? Is this one going to keep moving higher?
Good afternoon. Thank you for having me. We do expect Tesla to keep moving higher. It pushed out of a triangle formation a few weeks back, and those patterns are typically bullish when they resolve to the upside. In this case, we do expect intermediate term upside follow through, and we can derive a price projection of around 500, and that's at the top of a long-term secular uptrend channel. That's really the next major resistance level on the chart. We have seen an acceleration in upside momentum after that triangle breakout. We saw some brief consolidation, but really late last week is when we saw the momentum pick up for those that follow the MACD indicator. We've seen a positive divergence there to the upside. So everything in our work points to more upside follow through for Tesla looking out a few months.
So Will, let's say I'm watching this and I'm looking for a pullback. Where would the pullback in the stock be where you would say that would be a smart place to get in?
Sure. So when we see gaps up like we saw today, they sometimes can be exhaustive, especially after a few days of upside that we've already seen. So today's low will mark the top of that gap, and then the bottom of the gap, which is near 396. If that gap fills pretty quickly, then that would indicate that there has been some exhaustion there, and we would expect some short-term digestion and profit taking. And if we see that short-term pullback, the next level for Tesla is around 362. That's from the May high. So a former resistance level now turned into support.
So you see this one moving higher. Well, where would you call out overbought territory? What would be the levels?
Sure. On our long-term metrics, we have a lot of room to overbought territory, and we have support of those long-term trend following gauges like a 200-day moving average, for instance. I think if we got up closer to the top of that channel near 500, we would start to see more overbought extremes take place. An overbought condition isn't necessarily a bad thing. So once we see that overbought condition, a loss of momentum in response to that would be sort of the sell trigger, if you will.
You do know, Will, this one can be, fairly volatile. Is your point there just to make sure, listen, if you're going to move in, you've got to have the right stomach for it?
Yeah, definitely. In a name as high beta as Tesla, it can see outsized moves in one way or the other. You have to be careful, especially if you don't have an extreme risk tolerance. Our recommendation would just be to position size accordingly. If you are going to trade in and out of Tesla and your risk tolerance is low, just make sure that the position is a relatively small portion of your portfolio.
In the time we have left, Will, let's broaden out this chat. You look at the SPX, the S&P 500. I'm just curious what you see, Will, as we head into this Fed meeting and longer term as we head into year end.
Sure. So going into the Fed meeting, we have an uptrend in place with no concerning sell signals. So positive momentum. We're watching as a risk metric the 20-day moving average. That indicator we find is helpful in strong momentum driven tapes like we're in right now. So a trend following gauge like the 20-day moving average, if that rolls over, that would be a sign that we would see potentially a more significant correction, more so than we've seen over the past several weeks. And then we're also watching support at the 50-day moving average. That's just below 6,400 on the S&P 500 as another risk metric. So if we get below that, then things would start to deteriorate from a momentum perspective as well. And in a stock like Tesla, going back there, that's another thing to keep in mind are these top-down influences, because if we see that SPX break down, then Tesla would likely Tesla would probably go down as well, if not more than the S&P 500. But for right now, the trend is still intact with the support of that 20-day going into the Fed meeting.
And finally, Will, we are watching Treasury yields closely too, of course. Walk me through what you see in the charts there.
Yeah, so we have some key levels in play going into the Fed meeting this week. So the 10-year Treasury yield has an important trend line support near 4%. So that's a key level in the 10-year yield that we're watching. It's a nice round number as well. If we saw a couple of weeks, if the 10-year spends a couple of weeks below that level, that would confirm a breakdown in our work. and it would suggest that a cyclical downtrend in yields has taken hold on the 10-year yield, I should say. And that would put next support at 367 as a downside objective there on the 10-year. We're also watching the 2-year, which has support near 3.5%. Same deal with that one. If it takes out that 3.5% level, that's a long-term level. So a breakdown there would suggest that another cyclical downtrend has a hold there, and secondary support on the 2-year is 3%.
What if earnings season only came twice per year instead of every quarter? It's a simple question with some big ramifications, and that's what we're exploring on today's Stocks in Translation. President Trump sparked the debate on Monday on Truth Social, saying that subject to SEC approval, companies should no longer be forced to report on a quarterly basis, but rather on a 6-month basis. He said, quote, "This will save money and allow managers to focus on properly running their companies." Now, first, let's break down what financial reporting actually is. This is the required scorecard, what a company earns, spent, owns, owes, and what's changed so that investors can gauge performance and risks. Importantly, this does not include expectations for the future or so-called forward guidance. Look-ahead targets and commentary are entirely optional, as they always have been. Now let's rewind the tape and start at the beginning in 1934, when the Securities and Exchange Commission got the power to require periodic reports. It wasn't until 1955 that they actually gave a timeline, which was every 6 months. Then in 1970, the 10Q was born, which had to be filed every quarter. This also happened in Europe. Then in 2013 and 14, European and UK companies, they got some relief and were allowed to step down to every 6 months. But not many took advantage. A few years later, a study found that only 9% of UK companies actually reduced their reporting. Finally, in our timeline in 2018, back in the US, President Trump asked the SEC in his first term to gather comments from the public on stepping down to 6 months in the US. At the time, many corporate leaders weighed in, including the Business Roundtable and then PepsiCo CEO Indra Nooyi. They largely favored cutting down the reporting to be able to focus on the long game. But the point is, this issue has been around for years. Now let's set the stakes. If we cut reporting to twice a year, we're essentially trading less corporate homework for less information. That can feel great in the C-suite, but how does it play for investors? Well, let's focus on the pros first. Fewer filings can mean lower prep time and costs, meaning less make-the-quarter scrambles and more time running the business. For cons, there are fewer timely updates for shareholders, as well as bigger information gaps, which can favor insiders and pros. And it can also make raising money harder. Think of it as the price of money going up when investors see less. Now, what does the research say? Let's dig into that. One study found that more reporting means smaller jumps in price when financials are reported, and that it led to cheaper fundraising. But another study on smaller companies in Singapore found that making them report each quarter lowered their market value due to the higher cost. Another found that stepping down from quarterly to semi-annual led to less analyst coverage, which can disadvantage smaller investors. And finally, a study found that less frequent reporting led to bigger information gaps. Translation, the average evidence cuts both ways. Smaller companies can struggle with the burden, but markets generally like timely information, and context matters. So what happens next? Here's your roadmap. First, watch the Long-Term Stock Exchange, or LTSE, which has been vocal recently and is expected to petition the SEC. It's backed by Founders Fund, co-founded by Peter Thiel and Andreessen Horowitz. Expect a pitch framed around long-termism, as the name would imply. Second, watch the SEC's path. The agency already gathered comments in 2018, and it could now go straight to a proposal, but it could also run another comment period. Third, watch for investor pushback. Groups that prioritize transparency and fairness, they're going to weigh in fast. If you manage other people's money, you want frequent comparable data. And fourth, keep an eye out for white papers. If rulemaking moves, expect think tanks and consultancies to drop fresh studies about cost, liquidity, and how often investors really need updates. The bottom line is there are big trade-offs here involved, but we're going to keep tracking this issue as it evolves now that it's got some steam in it again. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts.
Since the release of ChatGPT 3 years ago, the 4 largest data center operators have spent over $500 billion on capital expenditures. And amid this AI boom, big tech has increasingly pushed into clean energy solutions for its growing power demands. Joining us now to talk more about this, Steve Liberatore, lead portfolio manager for Nuveen's fixed income strategies that incorporate ESG and impact investments. He oversees $22 billion in assets under management within these funds. Good to see you, Steve. Thanks for being here.
Thanks for having me.
So you invest in debt of some of these companies that we're talking about here. We know what's happened on the stock side. What's been happening on the bond side, and how are you thinking about these investments?
Yeah, fixed income is an interesting market because in order to be able to fund these types of projects, you can really look at it from a variety of different ways. And usually within fixed, how you're able to get exposure is directly to these data centers through either ABS or CMBS transactions where the individual properties are being securitized and you're able to invest directly in them. But given the way that the fixed income market is structured, you're also able to invest in projects that are tied to data centers. So you can look at individual renewable energy projects that are specifically tied by purchase power agreements to data centers. And also one of the things that we've seen more of is that these hyperscalers especially are very focused on environmental impacts and the recognition of what the energy consumption and utilization is, especially around energy and water from these facilities. So you're able to also look at projects that are creating carbon credits, for example, that are being purchased by hyperscalers that are reforesting, they're reforesting projects, or they're projects that are looking at the conservation of water in other ways. So it's a really unique way to get exposure to data centers, but not necessarily in the most obvious way you would think of.
And how heavily are you indexed to these kinds of investments in your portfolio? I was just scanning through some of what you have. I mean, you have things like treasuries and mortgage-backed securities also, and then you have the corporate side of it. So how heavily are you invested in?
Yeah, so we're managing, generally speaking, against the I was about to say the Lehman Ag to give away my age, but the Barclays aggregate. And within that, when you look at CMBS and ABS, those are generally smaller components of the index. So you're looking at maybe 5 to 7% in total, depending on how you want to break it out. So when we look at it, what we're looking for is really securities that look relatively attractive from a valuation perspective, because what we're doing is we're an active manager. And when we want to really find securities that we think provide that attractive valuation, we're looking forward to see where is the market trying to go, where do we see additional benefit, and managing portfolios that have sustainability associated or impact. These data centers really provide an opportunity because they're not as well known, not as well understood. So you get a little bit of an additional spread premium, but you're also investing in projects, like that have very high Energy Star ratings, for example, or are LEED certified. So you're able to find those opportunities that provide both relative value as well as positive environmental impact.
There's 2 terms in this conversation that I have to admit I haven't heard in a while: carbon credits and ESG. Yeah. In the Trump era, where we have really seen the administration push back against a lot of these terms, carbon credits, sort of incentives for green energy, it feels like that has been an out of favor strategy and way of thinking. So as somebody who does this, how do you navigate that?
Yeah, I think what's really been interesting is the fact that a lot of the, what we would kind of call the noise or the scrutiny of the space, I think is due to a lot of misunderstanding, right? When we think of the term ESG, for example, does any analyst not consider the governance of the entities they're investing in? Does any analyst not consider the environmental responsibility or effect of the businesses that they're investing in? So when we think of ESG, it's really more about credit analysis and how do we tie those factors to stability of free cash flow in the future. And for us as an asymmetric payoff asset class in fixed income, we're really looking for entities that are issuing and deploying capital in a way that makes their business generate more stable free cash flow in the future, because how we generate outperformance in fixed is not by picking winners, but by avoiding the losers. So by focusing on that stability of free cash flow, that allows us to identify entities and issuances that we believe will be better performing in the future from a stability of cash flow, which indicates a higher likelihood that we're repaid.
Gotcha. Steve, thanks for coming in.
Thanks for having me.
Appreciate it. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.